So I want you to imagine that you are holding a wallet. And inside this wallet is, well, $170 billion in cold, hard cash.
That is a very heavy wallet.
Right. Just an absolute mountain of money. And it's just waiting to be spent. And, that's not some hypothetical scenario. That is the actual dry powder, like the available unspent capital sitting inside Ares Management Corporation right now.
Yeah, as of their Q2 2026 earnings call. Exactly.
Exactly. So welcome to today's deep dive. We are going to look under the hood of this massive corporate update from Ares, which trades under the ticker ARES. We want to read between the lines here and figure out exactly where the smart money is flowing in the global economy right now.
Because, when we look at a firm operating at this scale, we are moving way beyond just a standard quarterly profit and loss statement.
Right. It's bigger than that.
Way bigger. By tracking where Ares is raising capital and where they are deploying that $170 billion, we can actually see the physical development of digital infrastructure. We can see the shift in global banking regulations and, the actual mechanics of the loans keeping everyday businesses operational.
Because Ares is just a financial behemoth. We're talking about a firm with $671 billion in total assets under management, AUM.
Yeah, $671 billion. It's staggering.
And they are funding data centers, they're funding massive real estate deals, corporate debt. So to really understand this, we're going to break down their financials, this huge pivot into asset-based finance, their strategy to capture the wealth of the everyday retail investor, and finally, their playbook for corporate acquisitions and artificial intelligence.
Which is fascinating on its own.
Oh, it really is. So let's start by looking at just the sheer scale of this money printer. The baseline numbers for Q2 2026 that they reported are just staggering. They announced a quarterly dividend of $1.35 per share.
Which represents a 20% jump year over year.
A 20% jump. In a broader economic environment where a lot of traditional banks and corporations are, hoarding capital or cutting costs, a 20% increase in a dividend is a massive structural promise to the market.
Right. It's a promise about the durability of their cash flows.
Exactly.
And that durability is rooted in the expansion of their underlying asset base. So their fee-paying AUM hit approximately $410 billion.
Wow.
Yeah, which is a 17% increase from the previous year. And that asset base translates into two distinct revenue streams for the firm. Understanding the mechanics of both is really crucial to seeing why institutional capital is just flooding into these alternative asset managers.
Okay, so break those down for us. What are the two streams?
Sure. So the first is fee-related earnings, or FRE, which came in at $491 million. That's up 20%. And the second is realized income, which hit $500 million, up 31%.
Okay, so structurally, fee-related earnings, the FRE, that represents kind of the holy grail for a firm like this, right?
Exactly. It's essentially subscription revenue.
Right. It's that steady, predictable management fee they collect just for holding and managing the capital. It doesn't matter what the day-to-day market volatility looks like, they get that fee.
Spot on. And realized income, on the other hand, is more like the blockbuster movie ticket sale.
Okay, how so?
Well, it comes from the actual performance of the assets. So when they exit an investment or sell a company or hit a specific performance hurdle that triggers a bonus fee, that's your realized income.
Got it. So seeing both of those growing, FRE at 20% and realized income at 30%, it tells us they aren't just accumulating assets to collect a lazy management fee. They're actively driving real returns on the back end.
Yeah, and the accumulation phase itself is accelerating. They reported a record-breaking fundraising quarter, securing $36 billion of gross capital in Q2 alone.
Just in one quarter, $36 billion.
Just Q2, which brings their total for the first half of 2026 to $66 billion.
That is wild. And that influx is what sustains that $170 billion in dry powder we talked about. But looking through the transcript, the metric that really seems to insulate their future growth is this line item they highlighted, $114 billion in AUM, that is not yet paying fees. What does that actually mean?
Right. So mechanically, that represents a legal IOU.
Right.
Think about when a massive institutional investor, like say a state pension fund, commits $1 billion to Ares.
Right.
They don't just wire $1 billion in cash on day one.
That would be a crazy wire transfer.
Yeah, the banking fees alone, right? No, they make a legally binding commitment. So the pension fund holds onto its cash until Ares finds a specific investment, like a warehouse to buy or a mid-market company to lend to.
Okay, so once the deal is found, Ares then calls the capital.
Exactly. And the meter for the management fee doesn't start ticking until that capital is officially activated, or in the case of real estate, until the development stabilizes.
Yeah. Okay, so the firm refers to this as a coiled spring of future revenue, because if and when that $114 billion is deployed, it represents a projected $828 million in incremental annual management fees, just waiting to be flipped on.
Right. It provides a massive buffer against macroeconomic shocks. I mean, even if global fundraising were to freeze entirely tomorrow, Ares has this built-in future revenue engine.
It'll just continue to drive earnings growth simply by deploying the commitments they've already locked in.
Exactly. And on top of that, 84% of their AUM is held in perpetual or long-dated funds.
Meaning they aren't vulnerable to a sudden bank run.
Exactly. The capital is locked up for years or permanently, so they are never forced to fire or sell assets in a down market just to meet investor withdrawals.
And they are spreading this risk out too, because the data shows that 70% of the capital they raised this year came from outside their 4 largest credit funds. It's diversified across 90 different vehicles.
Yeah, they're highly diversified.
But, this brings up a massive structural question for me. Because if you read the news, the broader transaction environment right now is pretty sluggish.
Oh, absolutely.
Traditional corporate mergers and acquisitions, M&A, have been really slow. And if private equity firms aren't buying and selling companies, the creation of new loans naturally slows down.
Right.
Yet somehow, Ares still managed to deploy $12.4 billion in U.S. direct lending alone. So if the traditional M&A engine is sputtering, how are they doing that? They must be leaning on a different mechanism to park all that capital safely.
They are. The mechanism they are relying on is their existing network of incumbent borrowers.
Incumbent borrowers. Okay, what does that look like in practice?
So when traditional M&A slows down, Ares just leverages its sheer scale. They have a massive portfolio of companies they already lend to. And when those companies need capital to, say, expand operations or refinance existing debt or make smaller add-on acquisitions,
they just bypass the broader syndicated loan market entirely.
Exactly. They go straight back to Ares.
So it's kind of the corporate equivalent of a bank giving a second mortgage to a homeowner who has never missed a payment in 10 years.
That's a perfect analogy, actually. Ares already has the company's financial x-rays. They've underwritten the management team. They monitor the cash flows daily. They understand the risk profile intimately.
So when traditional M&A slows down, Ares doesn't have to go out and blindly trust strangers to deploy their dry powder. They just increase the credit lines of the thriving businesses they already have a deep relationship with.
And the earnings call explicitly confirmed this dynamic. A staggering 75% of their Q2 U.S. direct lending deployment went directly to those existing incumbent borrowers.
75%, that's huge.
It allows them to deploy billions of dollars with a highly mitigated risk profile. So competitors who lack that decades-old network of borrower relationships, they find themselves really struggling to originate new loans in a slow market.
Right, while Ares simply taps its internal ecosystem to keep the water flowing.
Precisely.
But even with a massive internal ecosystem, having $170 billion in dry powder demands new, much larger channels for deployment, right? I mean,
Yeah.
If traditional corporate lending has a ceiling during slow M&A cycles, the capital still has to find a new home.
It does. And this is where the structural shift in the global financial system becomes really apparent. Ares is executing a massive pivot into 2 specific areas: asset-based finance and digital infrastructure.
Let's start with asset-based finance, or ABF. This seems like a direct response to a changing regulatory landscape. On the call, management was hyping up the explosive success of Pathfinder 3, their flagship ABF strategy.
Yeah, they were very excited about that one.
They went to market with a target of $6.5 billion and hit their absolute hard cap, like the legal maximum they're permitted to accept for the fund at $8.5 billion. And apparently, investor demand extended way beyond that limit.
It did. And you have to understand, the mechanics of asset-based finance are fundamentally different from traditional direct lending.
How so?
Well, traditional lending looks at a corporation's overall cash flow and EBITDA to determine if they can service a loan. Asset-based finance involves lending money against a specific, tangible, ring-fenced pool of assets.
So we are talking about like financing a fleet of commercial aircraft or a massive portfolio of equipment leases.
Or even a catalog of music royalties.
Yes.
And Ares explicitly stated they view this as a $1 trillion addressable market.
$1 trillion. But why are sovereign wealth funds and pensions flooding into this specific strategy right now?
Because the traditional banks are being forced out. There's this regulatory framework known as Basel III Endgame, and it's forcing traditional banks to heavily tighten their capital requirements.
Okay, so the banks are being penalized for holding complex, long-dated, or highly structured loans on their balance sheets.
Exactly. And as banks retreat to ensure their own regulatory stability, they leave behind a massive vacuum. Because the economy still requires financing for these physical and financial assets.
So private credit firms like Ares are just stepping right into that vacuum. And without the traditional banks competing for the deals, Ares can negotiate better terms, secure wider spreads, and basically capture excess returns for their investors.
All while anchoring the loan to hard, tangible collateral.
Right. But, I have to say, the immediate historical reflex for a lot of investors when they hear asset-backed is to immediately think of the 2008 financial crisis.
Oh, of course. Subprime mortgages, risky consumer loans, all bundled up.
Exactly. That's the ghost in the room. But Ares clearly anticipated that concern, right? Because they addressed it head-on during the call to differentiate their ABF strategy from those legacy toxic assets.
They provided highly specific data to counter that exact subprime narrative. The subprime consumer exposure across their entire ABF portfolio is less than 1%.
Less than 1%.
Less than 1%. And even in asset classes that traditionally have consumer exposure, like auto loans, they are dealing entirely in prime credit.
So their strategy is completely focused on high-quality, durable, cash-flowing assets, rather than taking these granular bets on an individual consumer's ability to, navigate inflation or a job loss.
Exactly. It's a completely different risk profile than 2008.
Okay, so asset-based finance handles the physical world of equipment and leases, but the other massive avenue for their dry powder you mentioned is digital infrastructure. And it looks like they're moving way beyond simply financing other people's businesses here. They are vertically integrating to build the physical foundation of the internet.
Yeah, their infrastructure team, which is called ADA, is actively developing 7 large data center campuses. That comprises 22 individual investments.
And the scale metric they used on the call, which blew my mind, is that they are building roughly 1 gigawatt of compute power.
A gigawatt.
What does a gigawatt even mean in financial terms or real-world terms?
Well, a gigawatt of power represents an astronomical energy footprint. It is roughly equivalent to the sustained energy required to power a mid-sized city of several 100,000 homes.
Wow. Just for data centers.
Yes. Ares is dedicating that entire power capacity exclusively to running the massive server arrays required for artificial intelligence processing and cloud computing. The hyperscalers, the massive technology companies driving the AI revolution. You have practically insatiable demand for this localized compute power right now.
And Ares is positioning itself not just as a financier, but as the primary landlord and developer for this entire ecosystem.
To accelerate that, they executed a really strategic acquisition of a company called GCP International.
Right. I saw that in the transcript. What did that acquisition actually get them?
Well, they didn't just want to buy a portfolio of existing stabilized data centers. They wanted to control the entire creation process. So by acquiring GCP International, they secured a market-leading real estate footprint in Japan. They consolidated a global logistics platform. And crucially, they acquired a massive seed portfolio of development opportunities along with a vertically integrated workforce.
A vertically integrated workforce. Okay, this is where the financial mechanics become incredibly lucrative, right? Because Ares now employs an in-house development team of over 100 professionals.
Yes, deep expertise in structural engineering, construction management, and power procurement. Which, by the way, power procurement is the ultimate bottleneck in data center development today.
So normally, just so I understand this, a real estate fund raises money from investors, and then they have to go hire a third-party developer to actually build the asset, right?
Right, and that third-party developer takes a significant cut of the profits as a development fee.
But by vertically integrating through this GCP acquisition, Ares acts as its own developer. So they charge that development fee directly back to their own fund.
Exactly. And that fee goes straight to Ares Management's bottom line as fee-related earnings, basically capturing the profit margin they use to just pay out to external vendors.
That's brilliant. The CFO actually projected that this vertically integrated model alone will generate an additional $50 to $100 million in fee-related earnings by 2027.
It's massive operational leverage for Ares itself, and it provides their limited partners with strictly controlled, high-quality development outcomes.
It really represents a fundamental evolution of the alternative asset manager model. They are acting as a shadow bank to fill the void in asset finance, and they are operating as a specialized multinational real estate developer to construct the physical architecture for AI.
But, alongside these massive institutional plays, there is a completely different demographic that is structurally altering the firm's growth trajectory.
Oh, right. The retail revolution. If you are listening to this and you have a 401k, or if you use a financial advisor, you are exactly the demographic Ares is aggressively courting right now.
Absolutely. Because historically, a firm like Ares only dealt with sovereign wealth funds or huge pensions writing $100 million checks.
Right. But the future of global growth requires tapping into the vast distributed pools of wealth held by everyday millionaires and the mass affluent. This is what they call the wealth channel.
And the capital is definitely flowing. In Q2 alone, Ares raised $3.9 billion to their wealth management platform. That's a 15% increase year over year. They now manage over $76 billion in total wealth products.
But, and there's always a but, integrating retail capital into private, illiquid markets introduces a highly scrutinized element of volatility. The financial media often refers to this as noise in the channel.
Yeah, that noise is loud right now. The primary source of the recent media scrutiny revolves around redemptions in their non-traded BDC.
Okay, let's break that down. A BDC, or business development company, is a regulated investment vehicle that lends primarily to middle market private companies.
Right, and the non-traded designation means the shares do not fluctuate on a public stock exchange like the New York Stock Exchange.
So investors buy shares directly from the fund at the net asset value. Like if an investor wants liquidity, like if they want their money back, they must submit a redemption request directly to the fund, typically on a quarterly basis.
But because the underlying assets, these massive private loans, are fundamentally illiquid, the fund cannot allow everyone to pull their money out at once.
Obviously not.
So they employ a gate, which strictly limits redemptions to a specific percentage of the fund's total value each quarter.
It's a pressure release valve, not a lock door. But when the volume of redemption requests exceeds that gate limit, it creates a redemption queue. And Wall Street media loves to see the phrase redemption queue and immediately frame it as a panic or a bank run, assuming investors are desperately trying to flee a sinking ship.
Which is why the earnings call was basically an exercise in using granular data to completely dismantle that panic narrative.
What did the data actually show?
Well, when management broke down the actual sources of the redemptions, it revealed a highly concentrated, localized issue rather than a broad retail panic. The core U.S. individual investor redemptions actually dropped 35% quarter over quarter. Yeah, settling at just 2.5% of the net asset value. And that 2.5% represents normal, healthy portfolio turnover for individual investors just rebalancing their assets.
So where did the spike come from that triggered all the scary headlines?
It came from a very specific, isolated pocket of capital. Management noted that it was driven primarily by a small number of Asian family offices and smaller international institutions.
I think I saw that roughly half of the total redemption requests originated from just 10 individual investors.
Exactly. 10 investors shifting their capital allocation created a media narrative that threatened to overshadow a fundamentally sound portfolio.
And the underlying health of that portfolio is really the most critical metric here. They reported a non-accrual rate, which, for you listening, is the percentage of loans in the portfolio that are actively defaulting or not paying interest of just 0.5%.
Which, in an economic environment characterized by sustained high interest rates, a 0.5% default rate is just a profound testament to conservative underwriting.
Seriously. Furthermore, the private companies borrowing that money are recording 13% organic EBITDA growth. So the underlying assets are thriving. It's entirely disconnected from the liquidity needs of a few family offices in Asia.
But to manage this structurally going forward, Ares isn't just ignoring the queue. They are allowing the current queue of Asian capital to naturally process through the quarterly gates, slowly draining the pressure.
But more importantly, aren't they designing new share class structures specifically tailored for different international regions?
Yes. They are looking at implementing longer lockup periods or redemption penalties for specific tranches of capital. The whole mechanism here is to perfectly align the liquidity expectations of the investor with the highly illiquid nature of the underlying private credit assets.
Making sure that a few large players cannot create concentrated volatility for the rest of the fund.
Exactly. It's a necessary structural evolution because individual retail investors have historically demonstrated pro-cyclical behavior.
meaning they panic and pull capital out during market bottoms when assets are cheap and flood capital during market peaks when assets are expensive.
Right. They do the exact opposite of what you should do. Managing that behavioral volatility requires immense operational infrastructure. Yet Ares is dedicating vast resources to this channel because the global pool of individual wealth simply dwarfs the institutional market.
I like to think of it like a highly efficient wholesale bakery. For decades, Ares has operated exclusively as a wholesale distributor, right? Selling massive pallets of bread to giant institutional supermarkets. It is a stable, low-overhead business model.
Right.
Moving into the wealth channel is the equivalent of deciding to open a storefront bakery on a busy city street. Selling a single croissant to an individual customer requires a totally different operational framework. You need new display cases, intensive customer service, marketing, and you're dealing with unpredictable foot traffic.
It's a massive operational headache compared to the wholesale model.
But the sheer volume of customers walking by makes the storefront simply too lucrative to ignore.
That's a great way to look at it. And to manage that storefront, Ares has deployed over 200 professionals, focused entirely on the wealth management channel. And they are actively innovating the product structure to reduce that friction we talked about.
Like what?
Well, while the non-traded BDC requires navigating those redemption gates, they are actively developing interval funds tailored specifically for the mass affluent and model portfolio markets.
Okay, structurally, how does an interval fund work? Is it a compromise between the strict illiquidity of a private equity fund and the daily liquidity of a public mutual fund?
Basically, yes. It still maintains a gate, perhaps offering to repurchase 5% of the fund's shares every quarter to protect the underlying assets. But it is legally and structurally designed to integrate seamlessly into those software platforms and model portfolios that financial advisors use every day.
So it provides the mass affluent with the smooth onboarding and portfolio management experience they expect from traditional public equities, but it still delivers the yield premium of private credit.
Exactly. And the success of this product innovation is evident in the numbers. Just look at their Evergreen Core Infrastructure Fund as a prime example. In just over 2 years, it has raised $5.7 billion from individual investors.
Wow.
Ares now ranks number 2 in the entire industry for gross fundraising in evergreen infrastructure. They've captured roughly 20% of the total market share.
So the growth engines are literally firing on all cylinders. The institutional capital is compounding. The retail wealth channel is rapidly expanding. They are physically constructing the data centers for the AI boom. And they are acting as the primary lender to thousands of middle market companies.
That's massive.
But there has to be a mathematical ceiling to how fast a firm can grow purely through organic hiring and fundraising. I mean, to successfully deploy $170 billion of dry powder, eventually you have to start buying up your competitors and fundamentally rewiring your internal operations to handle the scale, right?
Yes, which brings us to their M&A strategy and their deployment of artificial intelligence.
Let's hit the M&A first. On the earnings call, the CEO provided a really strict 4-part framework for evaluating inorganic growth, meaning the acquisition of other asset management firms.
The checklist dictates that any potential acquisition must be culturally accretive, strategically accretive, produce revenue synergies, and be financially accretive.
Let's break down the mechanics of that checklist because it reveals a very conservative approach to scale. Culturally accretive is probably the most fragile component, isn't it?
Oh, absolutely. Alternative asset management is inherently a human capital business.
Right.
If Ares acquires a firm populated by aggressive risk takers and attempts to integrate them into a culture of rigorous, conservative credit analysts, the culture will fracture and the top talent will simply leave.
So they have to match the vibe.
Yeah.
Then there's strategically accretive, which means the target firm must provide a capability or a geographical foothold or a distribution channel that Ares lacks.
Like the GCP International deal.
Exactly. Providing a dominant real estate presence in Japan is the perfect example.
And then you have revenue synergies, which require a structural advantage where the combined entity generates more revenue than the two firms operating independently.
So if Ares buys a firm with a distinct client base, they can cross-sell Ares private credit products to the new clients and vice versa.
Right. And finally, financially accretive simply means the underlying math must result in an immediate or near-term increase in profitability on a per-share basis for Ares Management's own stock.
This rigorous framework provided the context for a significant strategic tease during the Q&A portion of the call. Wall Street analysts were actively trying to get them to confirm if Ares is planning a massive acquisition to scale up their corporate private equity division.
Because Ares is universally recognized as a titan in credit and real estate, but their private equity arm is comparatively smaller.
Despite their current fund, ACO F6, generating top quartile gross returns of approximately 20%.
Yeah, 20% is incredible. And the institutional investors, the limited partners, are actively requesting to allocate more capital to Ares' private equity strategies.
So there is a compelling industrial logic to scaling this division rapidly through an acquisition.
There really is. As alternative asset managers grow into these global behemoths, the massive pension funds and sovereign wealth funds want to consolidate their vendor relationships. They would much rather deploy capital across multiple asset classes with 5 massive trusted partners rather than managing relationships with 50 specialized niche managers.
That makes total sense. If Ares significantly scales its private equity business through a major acquisition, they can offer a complete end-to-end suite of capital solutions to a corporate client. They can provide the senior debt, the mezzanine financing, and the actual equity buyout capital.
It captures fees across the entire life cycle of a business, and it deepens their leverage with global banking syndicates.
However, the CEO noted a structural caution regarding the private equity model. Unlike direct lending, which generates a linear, predictable stream of monthly interest payments, private equity returns are highly episodic.
Right. The firm only realizes massive gains when a portfolio company is successfully sold or taken public.
So the valuation of any acquired private equity firm must be perfectly calibrated to justify absorbing that episodic revenue volatility.
Exactly. And, managing the sheer complexity of this expanding empire, the integration of retail capital, the oversight of complex infrastructure builds, and potential massive corporate acquisitions, it requires an operational infrastructure that human headcount alone just cannot sustain efficiently.
Which introduces the application of artificial intelligence. And management discussed this not as some marketing buzzword, but as a fundamental rewiring of their operational mechanics.
They drew a very sharp structural distinction between 2 categories: productivity AI and applied AI.
Okay, what's the difference?
Well, productivity AI is the baseline implementation that most corporations are adopting today. It involves utilizing off-the-shelf large language models to draft emails, summarize lengthy meeting transcripts, or generate basic software code.
It provides a marginal efficiency boost for the individual employee.
Right. But applied AI, that represents the true structural transformation. This involves integrating proprietary AI models deeply into the firm's repeatable complex workflows.
Can you give an operational example from the call that demonstrates an immediate margin impact?
Sure. They're utilizing applied AI to automate the response process for requests for proposals, or RFPs. When a massive institutional client initiates diligence, they often submit a 500-question document probing every nuance of the firm's investment strategy, risk controls, and historical performance.
That sounds like a nightmare to fill out.
It is. Historically, a team of analysts would spend weeks manually extracting data from historical documents to populate the RFP.
But now,
custom AI models parse the firm's proprietary data lake to generate comprehensive first drafts in seconds. They're also deploying similar models for anti-money laundering compliance checks and the comparative analysis of dense, highly technical legal credit agreements.
That's incredible. But the structural mechanism that I think could genuinely create a sustainable compounding competitive advantage is how they intend to weaponize their negative data.
Yes. The negative data.
Because over the past several decades, Ares has underwritten and analyzed tens of thousands of potential investment opportunities. And while they obviously have extensive data on the loans they actually funded, they possess an exponentially larger mountain of proprietary data on the deals they ultimately rejected.
The concept of a negative data engine is profound. If you train a sophisticated machine learning model on the fundamental financial characteristics, management structures, and macroeconomic conditions of every single deal the firm has ever passed on,
and correlate that data with the eventual real-world outcomes of those specific companies,
you create an incredibly powerful predictive matrix.
Exactly. So when a new deal comes across an analyst's desk today, the AI model can instantly cross-reference the financial architecture of that deal against decades of historical rejections.
It can flag hidden risks, structural weaknesses, or macroeconomic vulnerabilities that a human analyst might completely overlook, simply because the AI possesses perfect recall of every mistake, near miss, or successful avoidance the firm has ever executed.
It fundamentally transforms historical rejections into an active, predictive engine for superior capital allocation.
And the financial implication of this AI integration ties directly back to a critical metric discussed by the Chief Financial Officer: FRE margin expansion.
The margin on their fee-related earnings.
Right. The CFO provided guidance that they expect the profit margins on their fee-related earnings to expand, approaching the upper end of a 0 to 150 basis point range.
So if the firm is rapidly growing top-line revenue through record-breaking fundraising, but applied AI allows them to process that massive influx of capital while keeping operational headcount and administrative expenses strictly flat, that operational leverage flows directly to the bottom line.
Artificial intelligence, in this context, is the literal mathematical mechanism for margin expansion.
It's not just a toy, it's the bottom line. Now, amidst all this aggressive focus on scale, capital deployment, and margin expansion, they dedicated a significant portion of the earnings call to detailing a structural innovation in philanthropy.
Yeah, which represents a fascinating shift in how alternative asset managers utilize their unique financial architecture for social impact.
Right. The Heirs Charitable Foundation noted that since 2021, they have deployed $68 million in grants focused on economic mobility, workforce development, and financial literacy. However, the specific structural innovation is a program called the Promote Giving Initiative.
To understand the mechanics of this, we have to look at how private equity and private credit managers are compensated.
Beyond the standard management fee, you mean?
Right. They earn a promote or carried interest. This is a predetermined percentage of the pure profit generated by the fund. It serves as a massive performance incentive for the investment managers.
So how does the Promote Giving Initiative work?
It was pioneered by heirs through their Pathfinder funds, and it structurally carves out a designated percentage of that performance fee and irrevocably commits it to charitable organizations.
So the brilliance of this structural design is that it generates massive philanthropic funding without degrading the financial returns of the limited partners. The investors aren't paying for it.
Exactly. The investment managers are voluntarily redirecting a tranche of their own performance upside.
That's amazing. And this initiative has now expanded far beyond just Ares, right?
It has. They have successfully aggregated a coalition of 15 different alternative asset managers, representing over $44 billion in pledged assets operating under this structure.
The compounding math on that coalition is just remarkable. They project that this specific structural alignment of performance fees has the potential to generate between $300 and $350 million in reliable, performance-linked charitable contributions over the next decade.
It really demonstrates how the sheer scale and unique incentive structures of the alternative asset management industry can be harnessed to create durable funding mechanisms for global nonprofits.
All right, let's synthesize a macro picture from all the data we've chewed on today. We have tracked the mechanics of a $671 billion financial empire navigating a complex global transition.
Ars Management is holding an unfathomable $170 billion in available dry powder.
They are successfully sidestepping the friction of a stagnant M&A market by dynamically increasing credit lines to their massive, pre-vetted network of incumbent corporate borrowers.
They are executing a highly strategic pivot to capture the vacuum created by Basel III banking regulations, scaling a massive asset-based finance operation to lend against the physical equipment powering the global economy.
They are moving beyond pure finance by vertically integrating development teams to physically construct the gigawatt-scale data center infrastructure required to sustain the AI revolution.
They are systematically dismantling the operational friction required to onboard the massive distributed pools of mass affluent retail wealth, utilizing structures like interval funds to smooth that liquidity mismatch.
Furthermore, they are actively hunting for strategically accretive corporate acquisitions to scale their private equity footprint.
All while fundamentally rewiring their internal underwriting and compliance architecture with proprietary applied AI models to drive compounding margin expansion.
So why does the granular breakdown of this specific corporate earnings call actually matter to you? Because the mechanics we've discussed today are actively financing the physical and digital architecture of the world you interact with daily.
It touches everything.
The capital flows orchestrated by firms like Ares are funding the massive real estate logistics warehouses that process your online orders. They're financing the gigawatts of power consumed by the data centers processing your internet searches.
And providing the critical credit lines that allow thousands of middle-market companies to employ millions of people across the country.
The foundational architecture of the global financial ecosystem is fundamentally shifting.
The traditional banking system is no longer the sole, or honestly even the primary, driver of global corporate growth. We are observing alternative asset managers accumulating hundreds of billions of dollars in permanent, perpetual capital.
They are originating massive, highly structured loans directly to corporations without ever involving a traditional syndicated bank desk.
They are vertically integrating to develop their own hard infrastructure assets.
They are building proprietary distribution channels to directly capture the wealth of the everyday retail investor.
And they're operating entirely outside the volatility of the public stock markets to fund, scale, and manage global enterprises.
So if these massive private firms control the permanent capital, originate the direct loans, construct the physical infrastructure, and directly capture the retail investor's wealth, well, it forces a profound structural question.
A very profound one.
Are traditional, heavily regulated banks quietly becoming obsolete in the grand scheme of corporate finance?
Are we witnessing the real-time construction of a completely new, privatized, shadow banking system that operates parallel to and perhaps is actively superseding the financial institutions the global economy has relied upon for the last century?
Tracking the flow of that $170 billion in dry powder is the only way to map where that new foundation is being poured. It is definitely something to deeply consider the next time you tap your credit card or load up an AI chatbot. Think about the massive unseen pools of private capital financing the servers humming in the background. Thanks for joining us on this deep dive. We'll see you next time.